If you're a business owner or thinking of becoming a business owner, this video is for you as we cover some of the most current tax laws for tax years 2019 and 2020. My name is Mike the CPA and welcome to Money and Life TV. The spreadsheet you're about to see is completely free to download. I've also included timestamps so you can jump to any point in the video as you choose to do so. Okay, just so you know, the tax law that we're talking about applies to United States tax laws, federal US tax laws, what it applies to. It's very important to note that the 2019 numbers that you see on this spreadsheet apply only to tax year 2019. That tax filing is actually due in 3/15 of 2020 or April 17th of 2020, depending upon which entity you operate. The numbers for 2020 actually apply to the tax filing that is going to be due 3/15 of 2021 or April 17th of 2021. So just keep those things in mind and let's move on down the spreadsheet. I have some updated numbers for you and a few new elements to the spreadsheet as well. However, last time I checked, I'm human. There's always a chance that I can make a mistake. If you see something that's incorrect, please let me know. Whether you're an existing business owner or you're new to owning businesses, these are the original tax filing due dates for partnerships, LLCs, and single member LLCs that are owned by partnerships. The due date is usually March 15th. You can extend that out 6 months all the way up to September 15th of 2020. Now, these due dates would be for the 2019 tax filing as I've listed here. Now, these due dates follow a calendar year end. If you have a business that does not follow a calendar year end, such as a business with a fiscal year end, then this is the general guidance of when your tax return would be due if you have a fiscal year end for your business. In 2017, corporate tax rates were 15 all the way up to 39%. Now for 2019 and for 2020, they're still 21% flat rate. One new element I've added to the spreadsheet this year, and now this is not anything new. This is not part of the new tax law. This is part of the old existing tax law, but tax penalties. If you have a S Corp partnership, just know that if you do not file by the due date, by these due dates we were talking about here, or by the extended due date, then you're going to face a $195 penalty per month, and that's either per partner or per member, depending upon how many people are involved in that organization. Those are some really steep freaking penalties, so just be aware of that and make sure you're getting your books cleaned up and getting your tax returns filed timely if you have one of these entities. The next two penalties listed here really more so relate to individuals, although it's currently not listed on this spreadsheet. More so than ever, it's really important that if you're a shareholder in an S Corp or a partner in a partnership, that you have good basis records of how much you put into your partnership, what your current partner basis is, and our shareholder basis is, and so on and so forth. The IRS is really starting to look for this information when you try to take losses or distributions on your personal return that are coming out of your S corporation or from your partnership. So just keep that in mind. The bulk of the questions I get related to businesses usually revolve around depreciation. So I've put the updated depreciation numbers here. This is what they were in 2018, and for 2019 you can find them right here. The numbers are still pretty much going to be the same going forward for 2020. This number has been updated to reflect the max 179 section 179 expense you can take. Then, just so you guys know, the 100% bonus depreciation is currently set to go through 12/31 of 2022. The important thing to know about Section 179 is you cannot use Section 179 to drive your business income below zero, but with bonus you can. The thing to know about bonus depreciation is you're actually expected to take full bonus on all new asset acquisitions unless you elect out of it. So if you don't want to take bonus or don't want to drive your income to a negative amount, then I would suggest you elect out of bonus. And when you elect out of bonus, there's a couple options you have. You can elect out of bonus for all assets, and when I say all assets, I mean all years of assets, like assets with a 3-year life, 5-year life, 7-year life, etc. Or you can pick and choose which asset years or asset lives you want to back out of. So you can elect out of all 5-year property, but still take bonus on all 7-year property, for example. But you can't pick and choose individual assets to take bonus on and then not take bonus on others. That you can have that discretion with Section 179, but not when you're using bonus. So if you have property with 5-year life and you want to take bonus, you have to take bonus on all of your property that has a 5-year life. And that's basically how that works. It's more or less an all or nothing kind of deal unless you elect out of certain parts of it. Moving on now to depreciation for automobiles. And I have some basic information here, but I have a very detailed video that goes way into more detail than this. I will link that video below, or you can find my tax video playlist where you can find that video. As of 2019, you can now take $10,100 in depreciation for the first year without bonus. If you want to use bonus on that automobile, you can now deduct up to $18,100 in the first year. In the video I produced on automobile depreciation, there are larger deductions on this, so check out that video if you want to learn more. Now, I know I've only listed 2019 here, but as far as 2020 is concerned, I believe these amounts are basically the same for 2020 as they are for 2019. To give you a quick tip of how this kind of stuff works, let's just say you buy a vehicle for your business that is truly used for 100% for your business. You pay $50,000 for that vehicle. You subtract out the max first year bonus, because that's what you want to take. So you back out $18,100 for tax year 2019. That leaves you with a $31,900 cost basis now in your vehicle that you can still depreciate over the next 5 years, or 4 to 5 years. For each consecutive year thereafter, you're still going to get a depreciation deduction on that vehicle as long as you're still using it for your business. I also included on the spreadsheet this year the lease inclusion threshold remains at $50,000 in 2019. And if you want to learn more about that, go to this publication via this link to the IRS website. Speaking of vehicles and business use and all that good stuff, let's talk about business mileage. In 2019, it was 58 cents per mile. In 2020, it is now 57.5 cents per mile as a deduction. Moving on to mills, entertainment, and fringe benefits. These rules really haven't changed since the new tax laws went in effect, but you're welcome to download the spreadsheet and read them right here. Most of the time, if you're entertainment related, it is no longer deductible now. It used to be deductible back in 2017. Now it no longer is. So you have to really look carefully at where you're spending your money, what that expense is used for. Meals for the convenience of your employer are still 50% deductible. They used to be 100% deductible, but that's no longer the case. And these become, as far as it's slated right now, these become no longer deductible at all after 2025. Meals that relate to business travel are 50% deductible. You can deduct 100% of meals or the expenses for the holiday party. You can do that. For the deductibility of employee gifts and awards, only certain things apply, which I've slated right here. Because of these rules, it is more important than ever, if you're a business owner, to make sure from an accounting perspective, you're separating out your true entertainment expense versus your meals expense. Lumping them together, meals and entertainment, is a no-no, so please do not do that anymore. Your accountant will thank you for separating those expenses out. The excessive business loss numbers have changed a little bit, so I've updated them here. If you're single, if you file single, now this really hits you at the individual income tax level, not at the entity level. For 2019, the amount now is $255,000. Married filing joint goes up to $510,000. And the amounts increase a little bit more for 2020 to $259,000 and $518,000 if you're married filing joint. Remember, if you have an excess business loss, which limits how much of a loss you could deduct in a single year, the excess loss turns into an NOL, which is a net operating loss that carries forward into future years, and you can take those deductions in future tax years. There are some entities that actually have NOLs, whereas flow-through entities like S corporations, partnerships, the NOL is actually occurring at the individual income tax level. Because remember, for flow-through entities like an S corp or partnership, LLC, that income and those expenses, even if it's a big fat loss, it passes out to the individual shareholder or member where they report that income individually, and that's where that NOL is generated for those type of entities. To give you a quick example, let's say a person has $100,000 in taxable income. Let's say their S corporation just took a huge loss. Well, their net operating loss is limited to 80% of their taxable income. And so even if they have a loss larger than this $100,000, they can't take it all. So they would be limited to 80% of that. So they could deduct $80,000 of that loss in that tax year. Portion of that, the $20,000, would carry forward to a future tax year where it can be deducted there. So even though they had this large NOL, they still might pay some tax that year because the NOL is no longer allowed to wipe out that person's entire taxable income. If you operate a business that has a substantial amount of interest deductions, then definitely check out this part right here. Remember, there's an unlimited carryover of disallowed interest. So if you can't use it in that year, it will carry forward to future years. There are some exceptions to help you avoid that cap on interest deductions. If you have a business with gross receipts that have averaged less than $26 million in the past 3 years. Starting in 2021, we're going to see some changes to business and research expenses. Right now, in 2020, expenses are still allowed to be deducted when paid or incurred, but you can elect to capitalize or amortize those research expenses. Let's discuss like-kind exchanges real quick. Remember, like-kind exchanges only now applies to real property, such as real estate. Vehicles are no longer considered real property, so you cannot exchange one vehicle for another and defer the taxable gain within that transaction. You're going to have to pay tax whenever that vehicle is sold. Let's talk about the QBI deduction. Now, this is the largest tax deduction that came out of the new law, or one of the largest tax deductions available if you operate a business. If you're a business owner, you are very, very happy with this deduction. And for example, like if you guys make like $50,000, let's say in business income, and you're able to get the full 20% deduction, that means that $10,000 of that income is no longer going to be subject to tax. So it's pretty cool. But for most people, they're able to take advantage of this deduction unless their income is really high, or unless they operate a service business such as an accounting practice, law firm, things like that. There are some new regs that just came out regarding real estate in 199A, so I will have to find the link and put it in the spreadsheet for you guys. So this row is for 2019 if you file single. This is for 2020, what the limitations are if you file single. Remember, if you get the full 20% deduction, as long as your income is under these amounts. You get no 199A deduction once your income exceeds these amounts. However, there are exceptions if you're not a service business. Once your income exceeds these amounts, you may no longer be able to receive a 199A deduction. If your income is in between those amounts, between like the 163 right here and the 213 right here, for example, you might be able to get a partial 199A deduction based on your circumstances. Now, these are the amounts for 2019 for married filing joint and for 2020 married filing joint. If you don't have a service business, then there's other venues for you to still be able to take this deduction, even if your income is higher than these amounts, which I've listed here. I have a whole video. I have 2 videos actually that cover how the 199A deduction works. I made them last year, but they're still relevant. You can check them out. I will link them in the description section of this video. One thing I added to the spreadsheet this year is retirement plan limitations. So for simple IRAs for 2019-2020, these are the contribution limits if you're under the age of 50. Also, these are the contributions for 2019 and 2020 if you're over the age of 50. These are the defined contribution plan limits for 2019-2020. And if you have a SEP IRA, these are the limits for 2019 and 2020. I wanted to leave you guys with a couple just general things to think about if you're a business owner and in regards to your taxes. People are often very eager to deduct everything from a depreciation standpoint in the first year, but I encourage you to think outside that box. If you expect your income to keep rising, especially as the years go on in your business, which I hope it does, then you're going to be facing a larger and larger tax liability as time goes on. So what I'm saying is, when you're thinking about depreciation, think about the future first before you decide how you want to go about it. If you expect your income to be larger in the future, you might decide not to take bonus depreciation or 179 at all, but just to depreciate that asset over its useful life. So if you have a vehicle that's over 5 years, if you have a piece of equipment that's generally 7 years, by spreading out the deduction, you're going to get that deduction over a 5-year time span or 7-year time span. And it's going to help you normalize your income for taxes going forward. And so you're not paying 0 taxes down here and then have a huge spike in tax liability on the next year and then have no deductions to back it up. So by spreading out that deduction, you're going to normalize the amount of tax you pay. You're not going to pay the highest, you're not going to pay the lowest in tax. So you're going to likely to pay somewhere in the middle, which is probably the most ideal tax result for most people. Another thing to note, it's important to remember that for pass-through entities such as an S corporation, LLC, partnership, things like that, remember you are taxed on that income in the year you earn that income. Doesn't matter if you take that money out as a draw or not, doesn't really matter. You are still paying tax on whatever amount of money you made during that year. I get a lot of questions regarding deductible losses on people's personal returns that relate to their business. And I will say that I think it's okay to show a loss, especially in your first year when you start a business, maybe in the first 2 years. But there are things as hobby loss rules that come into play. So if you keep showing a loss consecutively, what it's going to do is you're going to increase your chance of being audited by the IRS. If you keep showing losses year after year after year and so on and so forth, what the IRS can come in and do if they audit you is they can look at your books and records, and it's very important you keep good books and records, and they can look at your business and say, well, Mr. Smith, I think your business is not a business. I think it's just a hobby, and you have no real profit motive. And so because of that, we're going to disallow all those previous years of deductions you took, and we're now going to make you pay income tax on that. So you have to be careful with keeping good books and records and making sure you're legitimately trying to show a profit and earn a profit in your business. Once you operate an entity, especially like a partnership or S corporation, it's very important, in my opinion, that you take the time to do tax planning. If you want to do it yourself, fine, but seek out an accountant, an EA, a CPA, whoever, to help you with this, because it's going to help you save a lot in taxes if you do some tax planning, and they're going to help you form strategies around your business and where your business might go in the future. Also, it's going to help you determine what you might owe going forward and help you better manage your cash flow so you don't go into debt with the IRS. All these things are very important to do. When you're thinking about expenses for your business, if you truly need them for your business and you truly think that expense is going to help you grow your business, help you serve your customers, help you grow your profit margins, and so on and so forth, then yes, I think it's a good idea to make that investment and spend that money in those areas. I don't think it's a good investment if you just want to buy things to try to save on tax. Because if you don't truly need something and it's not going to help you in your business, well, then you're really spending $1 to only save $0.25, and I don't consider that good common sense. I don't. And that's what I advise my clients to do. Never spend $1 to save $0.25. All right, everybody. Well, thank you so much for all the requests for this video. I really hope you enjoyed it. I really hope you got a lot out of this. Leave your questions, your comments below, especially since I'll be doing a Q&A tax kind of video in the future, probably in February of this year. I'm just going to pick a bunch of random tax questions and I'll see if I can address them in a future video. So make sure you leave those questions in the comment section below. If you liked today's video, be sure to drop a like. Let me know in that comment section how these new tax laws are affecting your business. Is it helping you? Is it hurting you? How has it changed the way you do business? I would love to hear your thoughts in the comment section. Lastly, if you're new to Money and Life TV, welcome. Here on Money and Life TV, we help you become fiscally fit as we teach finances, investing, taxes, and more on a regular basis. You can subscribe to the channel for free by hitting that red subscribe button down below. And if you hit that little bell notification icon, it's going to notify you every time I release new content on the channel, which I try to release a new video about once per week, usually every Sunday. Thank you so much, everyone. It is truly an honor to be able to spend time with you on YouTube. I hope your tax filing goes well with your businesses and your personal income tax returns. I will see you in the next video. Until then, live life uncaged. Peace.